Hello everyone, I'm Zahid and from Talks at Innovation Valley, and today we have very amazing guest in our podcast show, Jack Lovern.
Hello.
Jack Lovern is a fund management senior analyst at the Carlyle Group, former investment and portfolio analyst at Incutel, a VC firm, a technology investment firm that invested in Google and Facebook in their early days when both companies were early stage startups. So I really warm welcome you to the show, Jack.
It's an honor, Zahid. Thanks so much for having me. I'm excited to be a guest. And I've been listening to Innovation Valley in the past for my own interests, and I've heard a lot of great guests come on.
You're welcome, Jack, and thank you for joining. So, audience, today our topic is very, very amazing. I observed that a lot of people don't know a lot of jargons and words about the startup and startup related financial and investment terms. So, today's topic is understanding investor jargons, startup related financial and investment terms. So, Jack, before we jump to the questions, I would request you to give your brief story. Share your entrepreneurial journey so far from where you got your schooling, higher education, and how you got to this like financial domain and startup domain, and how you when you joined Incutel, how was your experience with the Incutel, and after that, how is your experience going on right now with the Carlyle Group?
Sounds good. Yeah, I really enjoy sharing like my story and all the different paths I've taken. I've had a lot of odd and exciting jobs. Carl, I'm by no means the head honcho or make a lot of important decisions, but it is a really exciting place to work, and I've learned a lot from it. So like Sahid said, work in private equity in Washington D.C. I'd say private equity is a pretty numbers focused line of work. There's a lot of things that we track. I was a math econ dual major in college, and I knew I wanted to do something number related. I started my career, I was in North Carolina for college at a school called Wake Forest, and I came up to DC, start my career in market research at a higher education firm. And I thought it was really cool having colleges and universities as our clients. My job there was to find profitable markets for those colleges to launch degree programs in, have more cash cows for the universities, and make the universities uh, more profitable and bring in more revenue. At that time, we were acquired by a private equity firm called Vista. And I thought, hey, I could maybe do that. I could be good at that since I'm good at finding markets that are attractive for universities and attractive for professionals to go into. Maybe I could find profitable businesses for companies to buy. So I got my MBA at Georgetown to train up for that. I was more interested in the startup space and working with those startup founders. The problem was that as I did these internships in venture capital while I was in my MBA, there wasn't a lot of data to work with for some of these companies that were early on in their development. And I really wanted to be more of a data analyst and a modeler. So I came to Carlisle on the fund management team to um, the role of the fund management team is to primarily track how the investments are doing in aggregate and figure out what actions we can take to keep this going. So if I had to say what kind of skills I've developed from that, it's being able to learn about industries and figure out what makes them tick, be good at building models and tracking things, and solving problems, sometimes quantitative or complex problems, to uh, build better businesses, or at least make them more efficient.
All right, Jack. Really amazing journey and amazing experience. So, Jack, my first question is, how do you get in private equity and what experience do you think prepared you well for your role?
Yeah. Um, there's not just one path to private equity. It used to be that there were smaller PE shops that needed a deal maker to come in, somebody out of a top MBA program that could go work on these deals. But as they've gotten bigger, there's a lot of nuances to private equity and different opportunities that you can work in. So any job where you use Excel in modeling capacities, extremely helpful. Excel can get you pretty far in private equity if you use it well. And you also need to have really strong finance fundamentals. And the most important kind of driver behind our work is the earnings of the business and the free cash flow that those businesses spit off and finance our operations. So you need to understand how to get like how everything in the business gets there and what could impact potentially those earnings of the business in a very accounting analytical kind of sense. So I think venture capital, investment banking, accounting, and auditing are very helpful fields to prepare for private equity. um, those are all kind of in the finance sector, but there are possibilities to transition into private equity from a different industry if you're very much a numbers person in a marketing firm and you can kind of track profitability of ad campaigns. If you're an operator of a business and you've had experience running a business and you want to transition to private equity, I think that would work really well. You just have to be comfortable with analyzing businesses and keeping track of a lot of things.
So, Jack, my next question is, can you give us an overview of what someone in private equity does and what your specific role is?
Sounds good. Yeah. If a single person was a private equity firm, if they were doing the job of an entire PE firm, um, they'd, I can give it to you in kind of a simplified way to start. So they would go raise money from investors. These investors can be um, asset managers, mutual funds that are investing in public and private markets. They can be pension funds or wealthy individuals. Essentially, any person or group that wants to allocate a portion of their capital to the alternative asset class. We would then take that money and pool it into what's called a fund. So they would go around all these investors and get um, 10 million dollars, $100 million, $10 billion, any kind of target that they're shooting for, and then they take that giant fund and buy up a collection of businesses. It could be 4 businesses, it could be 40 businesses, depending on the size of the fund and the size of the businesses that they wanted to buy. They'd hold on to these companies in their portfolio for um, could be a year in extreme case, or it could be 8 years if there's not opportunities in the market to sell that company. And the whole time they're holding that company, they're trying to increase the value of the business. There's a lot of ways they can do that, but they want to grow the business and make it more profitable. And basically, that will increase the value of the company itself. And when they go to sell that business, they're hoping to sell it for a multiple of 2 or 3x of what they bought it for. And then they'll return the majority of that money to the investors, and they'll take a portion of the money as a commission. We can talk about like the fees they kind of take, but that's basically how private equity works in aggregate. I'm on the fund management team, and it's kind of like the operations of the fund, and it sits in the middle. And works with all the other businesses to help keep things running. So it's tracking how everything's going, and then it will work with our capital markets team to facilitate the transactions and make sure we have the financing for that. It'll work with the investment team who's buying these businesses to help with the due diligence process. It will work with what's called our investor relations team, who does a lot of the fundraising, and then it will work with our partnership accounting team to make sure we have like all the data from these companies that we need and require, and analyze and report that up to the Carlisle company level, essentially. So yeah, I like fund management because we're making a lot of tweaks to the business. We work well with a lot of the other groups and have a pulse on everything.
All right. So Jack, how is your team and the teams you work with structured?
The At Carlisle, it could be different at other private equity firms, but I mentioned kind of these private equity funds. A smaller private equity shop may just have a couple funds, but I mentioned they last, 3, 4, 5, 10 years long. That the private equity firm could be kind of running this fund. And so at Carlisle, we have a bunch of different funds for a bunch of different investment products that we think our investors will be interested in. So there are funds broken out by region. There's the fund that just focuses on US businesses, one that focuses on Europe businesses, Asia businesses. There's a real estate fund. There's sort of a technology fund. And we have our teams. We have some central teams in Carlisle that do everything, but our teams are basically structured to support each of those fund groups. So my team just supports kind of the Asia funds, and each fund will have one of us. They'll have a fund management team. They'll have the investor relations team that I talked about. They'll have an investment team, and they'll have a partnership accounting team. So all of these mini teams of 5 to 10 people will be supporting this fund. And on fund management, we have the top of our fund management team is a chief financial officer that is like you'd have a CFO of a business. He's like a mini CFO over the fund. And then beneath him, there's vice president, him or her, there's vice presidents, there's managers, and then there's analysts like myself. And so basically instructions and processes will get handed down to us, and then we'll work with the data. We'll work with our other analyst counterparts on the other team, and yeah, just take on projects and keep things running.
All right. Uh, how do private equity firms create value for their shareholders?
Good question. Yeah, you always, everything you do, you want to keep the shareholders in mind, and figure out how you can get a better return, because it's a very competitive field. They could just take their money and go to another private equity firm that's doing better. So we want to have great investments and make great returns, but we also want to do things as like operate as a company as efficiently as we can, so that we don't risk the shareholders' money more than we need to, and we get them the money back as quickly as possible. So to walk you through it, private equity firms will ask investors to make a certain commitment of X dollars into the fund that they're raising. Depending on if it's a bigger investor that can give more, they might get more discounts, or we might take less fees out of their commitment of money. And then, as I mentioned, we'll hold on to the money for 5 or 10 years. So it's locked up for a while, which is different from investing in stocks where you can buy and sell them at any time. Once they commit money to us, we'll get the commitment from them up front, and then once we are buying a business, we'll say this business might be a $2 billion, like a really big company that we're buying, a $2 billion investment, and we need 15% of your initial commitment. We're taking 15% of all of our limited partners, and we're putting that money into buying this company. And then they'll give us that money, and they'll hope to make a better return than they might in the stock market because they don't have that liquidity. So we will kind of break it down. The value creation will increase the revenue of the business and will increase the profit margin of the business, which will result in more earnings. That could be EBITDA or free cash flow, what we're measuring. But essentially, once the business has more earnings than before, when we sell it in a market to another strategic buyer or another private equity firm, or even take that company and have an offering in the public markets, that company will sell for higher, because if we double kind of their earnings, then we could theoretically double the value of the company, what somebody would pay for it. There's also implied multiples in the market, which is essentially investors' willingness to buy a business based on that earning potential. So it could be that investors, which before would only pay like 6 times a company's yearly earnings to buy the whole business, would now pay 8 or 10 times yearly earnings to buy the business. So that, if we can get a better multiple for it, can also return the value to the shareholders.
All right. So, can you walk us through the due diligence process when considering a potential investment?
Yeah. The due diligence process at Carlyle, it's run by our investment teams. They're the architects of that process. They kind of pride themselves on theoretically knowing what a good business is, or a bad business or a bad deal might be. But we provide a lot of the data and analysis for them across that process. So they'll high level, they'll look at the business and they'll think about what factors are involved in owning the business. Does it have a stable revenue stream? Does it have a lot of debt in the business? How is it structured? Who are the customers? Is it dependent on just a few customers, and there could be risks if one of those customers leaves or goes somewhere else? Or is it diversified across a lot of different income streams that have a lot of price inelasticity? So people will be buying from them regardless of what happens in the market. So that's kind of how we'll look at the business and the factors. Then we'll look at other risks in the business. Like I said, like kind of how exposed it is to the market and its competitors. And then we'll look at potential returns. Does this business have a high growth potential? Could it be more profitable? Is it being run efficiently? And from there, if all those signs point to yes, then they'll kind of begin their formal process. So there's probably about 4 or 5 steps with the due diligence. Step 1 is initial screening. The investment teams will build a report on the company to show like our executives how this investment would support the investment criteria of the fund, how it aligns with our industry focus, what are the strategic objectives of the business. Then step 2, once that's gotten sign off, is more in-depth analysis. So they'll prepare company presentations. They'll look more at the financial statements of the company. And this is when you may have kind of a non-disclosure agreement. You may submit a letter of intent, which is your intent to buy the company. And they'll share more of the confidential under the hood information about the company of what's going on. So you look at a lot of the proprietary data in the company and build presentations off that. Then you might look at what peripheral things or things that don't uh, pertain as much to the fundamentals of the company. You might look at kind of the commercial market. You might look at legal and regulatory things happening and ESG components of the business too, and what the values are of the company and how it aligns with the values of Carlisle. That's all done to anticipate other risks or other factors that might impact your ability to operate and sell the business. And then once that's done, then you'll kind of get approval where we're interested in this business. You'll get into the deal component, which is step 3, valuation and deal structuring. So we'll build a valuation model of the business, kind of estimate how much we'd be willing to pay for it, always thinking about what is our target sale of the business. Does this give us a good return if we buy it at X price? Other bids from other investors will come in, and then we'll figure out how we sit competitively in our bid. And then from there, if that's a match, if our bid is high enough to buy the company, then you'll negotiate kind of smaller payout details. You'll make sure you have all the legal documentation and transaction documentation for the company. And then there's just the closing process where the lawyers get involved and we kind of sign off on everything. And hopefully it's a good investment.
All right. Jack, beyond acquisitions and exits, are there other transactions you will perform related to portfolio companies?
Yeah, so this might be good for people who, have a big finance background and want to figure out like kind of what the more complex things that the private equity funds do. They kind of pride themselves on being financial engineers and doing kind of complicated financing in the business that other investors might not be able to do, that are more passive investors perhaps. So there's a couple things. I think bolt-on acquisitions and divestitures are 2 big ones that private equity firms will focus on. The first one is adding more to the business, and maybe you've bought this business, but it doesn't have this product, and you buy a smaller company that sells that product, and then you perform a merger into the company and make it kind of a more well-rounded company that would create synergies for the business and build a better business model. You could do that divestiture, which is essentially taking a component of the business and selling it. Maybe there's a not very profitable part of the business that this company has that you want to get rid of, that you think if I sell this not at a very high profit, if I sell this off, then the business overall will be much more attractive. It could work the inverse of that, where it's a really hot part of the business, really attractive part of the business that a company wants, that you could sell and then worry about the bulk of it as a whole, but you're essentially breaking it up into pieces. A third kind of more nuanced capital structure financing that we do a lot of on the fund management team is called recapitalizations or dividend recapitalizations. And when you buy a company that is a stable business, it doesn't have a lot of debt, and perhaps you've paid off a lot of your acquisition to the company that you bought it from, then you might consider taking on more debt into the company. So you load the company up with a higher degree of leverage or debt, and then you take that money that you've borrowed and give it to the shareholders. So they get a return, they get a portion of their money back before you've actually sold the company. So that will improve the investment performance metrics for investors. There's a lot of other crazy things that could happen, but I think those are the three big ones to know.
Right. Jack, what are the key performance metrics that you track for your funds, and how do you benchmark your performance against competitors or the broader market?
Yeah. So it's interesting in private equity, MOIC, or multiple on invested capital, is king. That's what PE firms like to tout a lot of and compare it against other private equity players. They'll say, you gave us $100 million and then we returned to you $250 million or $350 million from that initial investment that you gave us. So essentially, how much did your money multiply before we returned it back to you? That doesn't really incorporate a time component in the business. So it probably matters a lot if you get a 2.5x MOIC on a 2-year holding period versus a 10-year holding period. The 2-year holding period looks a lot better because you could then take that money that you got and be investing it in something else for those 8 years. So the metric that's become a lot more popular that investors care a lot about is IRR, internal rate of return. And you'll hear this not in private equity, but across any investment, which is the benefit of IRR because it's comparable across other asset classes. Essentially, what is my annual return on this investment? And private equity firms, especially those that are top performing, like to always show how they beat the public markets and say if the return this year was 9% in the stock market, we kind of gave you a 14% return or something like that. Private equity returns tend to range between 10 to 20%, but it can be outside of that as well. And then the third metric that I think we spend a lot of time on is total value to paid in capital. And that's more of a sort of absolute value of a number where it shows what value is gained outside of the initial investment that you made in sort of absolute terms.
All right. Jack, what reports and deliverables do private equity firms put together to track their work and communicate their performance?
I think that there's my job's really interesting because there's so many different groups that we have to communicate our progress to and share what's going on. So there is for acquisitions, we do different reports. For general portfolio management, we'll do reports. Then there's fundraising, and then there's internal strategy and presenting things to our executives. So just to give you, high level, acquisitions are normally we'll be putting together investment memos and due diligence reports when we're doing those acquisitions. When we're tracking our portfolio to see what's going on, every quarter we'll do valuations on those individual companies. And those valuation reports are essentially an Excel model of here's what the company's earnings are, here's what we think the market multiples are on those earnings, and what the company would sell for today. So on those years that we're holding the company, we can track our progress using valuations. Then there's the LP, which is limited partner. That's another name for our investors, to put it a simple way. But our LP prospectus, our LP prospectus will communicate what our targets are for this new fund that we're raising. We'll send them reports that show that MOIC, IRR, and TVPI, so that these investors can see if we've been doing well as a fund or we've been having some issues. And then there's the internal strategy component. So we'll do an investment advisory council, which is essentially all of our execs and other advisors sit on a board that reviews what our investment strategy has been, and my fund management team will build PowerPoints that we'll go through to communicate. Here's why, kind of on the inside of the door, we'll be talking openly. Here's why we think this company didn't do well, and maybe it was a good investment and it's had market challenges, or maybe we need to rethink our thesis a little bit in this area moving forward.
All right. Jack, how do private equity firms make money? What fees do they charge to their investors?
There are two fees that private equity firms charge primarily. There is the management fee, which is a small annual fee on the total raised capital. Sometimes private equity firms will do, hey, we're going to charge the management fee 2% on the committed capital for investors. And then sometimes PE firms will say, we're going to do 2% on the money we've actually invested out of this fund that we've raised. So every year, private equity firms will take generally 2% of the total money out of the fund, and they'll use that for their day-to-day operations, for like base salaries and for expenses to run a business or run their business. And then there'll be some discounts to that. Like I said, private equity firms are tending to discount the management fees more, closer to 1% of capital, because it doesn't show performance, or they're not being paid for performance in that way. On the flip side, you have the carry, which, let's say a company that we bought for 100 million is sold for 200 million. So there's 100 million of profit coming out of that, right? Essentially, of the 100 million in profit, the investors will first get back their original 100 million. So 200 million came in total from the fund. We give back the 100 million, but then there's 100 million profit to break up. So we'll give back to the investors 80% of that profit, because it's their money and they kind of took the risk in putting up that capital. Then the private equity firm will generally take 20% is industry standard. So they would take 20 million out of that 100 million for themselves. That's a little more popular and a little less discounted than the management fee, because it shows more you're paying for performance. So if the private equity firm doesn't make any profit, they're not going to take carry. They might take a management fee just to keep business running, but they're not going to take that extra profit because they didn't create it. So then, the carry will basically come out of that. It might not be the whole 100 million, because private equity firms might say, here, we're going to have this hurdle rate in place, and a hurdle rate kind of is the free or guaranteed profit that you might be getting to compensate for what you would get in the market. So private equity firm might say, we're having a 5 or 6% hurdle rate potentially. So any profit that is just a 5 or 6% return, we'll give that all back to you. And then anything over that, that's where we'd be taking that 20% of profit. So as you start to do those discounts and different adjustments, that's when you kind of need to put it into an Excel model. That's what our fund management team does. And you're also tracking other expenses, such as partnership expenses and expenses that you might expense directly to the portfolio company.
All right. Jack, how does private equity benefit business innovation?
Yeah, private equity as an industry is not free from criticism. There are, private equity firms that buy distressed assets. They may have to make layoffs to make the business profitable again. So people often question what the value of private equity is to the economy as the whole. I believe that um, there are two important functions of private equity in the economy. One is that it provides a payout to startup founders, and venture capital investors, to put it simply. So when a startup's young and they're getting all this investment in hopes of a future return. When a private equity firm buys them, then the original company and its founders can take that money, they can pay themselves, and they can pay the venture capital investors who invested in them early, believed in them, and took more risk into the business or on the business, and deserve to get kind of paid for that early money they put up. And private equity acquisitions facilitate that happening. The second thing is that I think it's a good alternative holding spot for businesses that want to grow more and mature before they get to kind of the next stage in business. So before, there was primarily, you might get acquired by a bigger company. If you get really big, you might have an IPO and go on the public markets. Now with private equity, whether there's mid-market private equity that focuses on smaller businesses or large private equity firms, there's the option for businesses that are growing to have that holding spot where they can be owned by a private equity firm for 5 or so years and continue to grow. And then they might be in a better position to go public or get acquired by a company. So it's kind of a great bridge financing period that PE firms offer.
All right. Jack, how does the private equity market changed in recent years?
I have only been in PE for not even a year. Followed it before, but I think the changes from 5 years ago that people might be seeing, if I could speculate, is that the multiples are much higher. They've come down a little bit since 2021 and even 2022 because of the economy. The valuations have compressed, but I think people are doing a lot bigger deals. Companies are continuing to consolidate. Um, Saw JP Morgan buy First Republic, and that's kind of a separate thing, but you're kind of seeing more and more of the big players come in. That's not just in banking, it's happening in other industries, and private equity is the same way. There's record levels of dry powder for private equity companies, which dry powder is money that private equity firms are sitting on and they haven't invested yet, and it's not in a business. They're just holding on to it. So I think what's interesting is that private equity firms have been fairly successful in still raising money, but they feel that there's less deals to be done at this point. So it'll be interesting to see how that impacts valuations. And I think there's more secondary markets. The company or kind of private equity is becoming more and more nuanced. There'll be private equity firms that just want to buy an ownership or an equity stake in another private equity business. And we'll call that general partner stakes, because the private equity firm is the general partner, and then the investors are the other limited partners. And there are a lot of deals being done where they just want to buy a piece of the private equity firm itself. There's more private equity firms going public, Carlyle being one of them, um, went public about 10 years ago. And I think they're getting more savvy with their data and technology that they use, which is starting to make my job more interesting. And there might be, with AI, more things that we can automate and run more efficiently.
All right. Jack, what distinguishes a top performing private equity firm from the rest of the industry?
That is, that's the big question. And Carlisle, thankfully, is one of the bigger players and has had some success. I think it does come down to the reputation of the private equity firm and the relationships that they build with investors and with top management at companies. Um, it's At the end of the day, it kind of comes down to, you know, what you can do to raise money from investors. And when private equity firms begin to get more and more scale, they can get in on better deals. They can get better financing, better interest rates on their debt that they're putting into private equity deals. So it's kind of a self-reinforcing cycle where if you have a good reputation, you can raise more money and then you can do better and perform better as a private equity firm, which increases your reputation. So to get there to having a good reputation, I think the best PE firms uh, really do their homework with due diligence to minimize risks and minimize the chance, hopefully, of making bad investments. They bring on a lot of people with great experience in private equity markets, and they also bring in people with experience in other markets so that they have a good mix. And I think they don't get too opportunistic, with what they invest in, because each year there's always going to be something that is the thing to invest in, and there's kind of a craze of investors. I think over years and even decades, they get better and better at what they do within specific markets or investment types. And that distinguishes them where they can outperform against other investors.
All right. Uh, Jack, what are some common misconceptions about private equity?
The ones I've heard is that private equity is. I'll go through a few of them. Private equity just focuses on getting rich quick, flipping companies as quick as possible. They're cutting jobs and doing damage to the businesses and to the people. They're only wealthy people invest in private equity. And that they take on like a ton of debt to uh, do these transactions. And that's kind of like the reason they make these outsized returns is because of the risky leverage. To kind of address those, I think private equity firms are more cautious than ever. They don't want to be part of the uh, damage and instability that's happening in the economy, where uh, maybe banks are getting over leveraged and they get insolvent or they're not able to continue their operations. Private equity firms are great managers of risk, especially very seasoned ones. So I think there are situations where they can put debt into the company, but they're very cautious, especially now. They're more long-term focused than most investors, because if you're investing in public markets, there's quarterly earnings released at every quarter, every 4 times a year. And that will, like, essentially people are selling companies if they don't meet their earnings for a quarter, or they're switching and buying a company. It doesn't matter too much. We don't put too much weight on quarterly earnings or even annual earnings for a company. And we give them the flexibility and time to make investments, make more meaningful investments in the company for growth over a period of several years. So companies that are owned by private equity firms are more, they can be more flexible and patient than companies owned by the private markets. Um, and so I don't think PE focuses a lot on short-term gains. They play the long game. And then private equity is not only for wealthy people. I think there is the traditional model where wealthy individuals would get in on it, but technology is really disrupting that. And we're trying to be more flexible in terms of approaches to let smaller investors get into private equity. And then also, if you think about it, your portfolio, if it's managed by, if you have a pension or retirement fund, they're putting 10, maybe even 20% of that money across the private equity industry. So you may be getting higher returns already than you would just in the stock market, because you do have a piece of your savings in private equity funds, even if you might not realize it.
All right. Jack, now I have would love to ask some very quick questions, kind of, where you will be giving just basic definition or brief introduction of that term actually.
Yeah.
So then I will ask you two questions in the last. Okay, so usually we listen the word term sheet. What is term sheet, and what is the scope of it when we talk on the startups who
Yeah.
raise funding?
Yeah. Term sheet is a little bit more talks about the like kind of ownership and like kind of ownership style and privileges and different like actual legal rights a buyer or investor will have into a company. So there is a form of term sheet for private equity deals, but it's more about it, like private equity focuses more on the valuation or like sorry, the acquisition as a whole and how the company is going to be bought. And it just assumes that if a company has 100% ownership or even like majority ownership, where they own 2/3 of the company, they're going to pretty much be able to make any decision that they want with the company. And when they sell the company, they'll get kind of all those returns as well. So it's a little bit more simple in some ways than venture capital, maybe, which venture capital relies a little bit more on term sheets, because if you think about startups, they're raising money. The founders may have put some money, or they just get a piece of ownership automatically in the business to start. And then they're giving pieces of ownership to other investors that come along that will give money at different stages of the business for like different ownership percentages if they buy 1% or 10% of the company. All those owners of the business will come on to what's called a capitalization table or cap table. And these owners on the cap table may have different rights, and their shared rights that they all have will be kind of a set of specific agreements. So there's not a battle for control over these startup companies. So what a term sheet does, it will have numbers in it, like we're investing this much for X% of the business. Here's what we would expect to get, or here's what we would get in the next like exit of the company. If there's another financing round, we would get involved too. But there's also, so now I'm getting into more of the kind of legal qualitative rights that a company might have. And there's things called pro rata rights that I just started getting into, where when a company raises a next financing, the prior investors may be entitled to invest a certain percent into the business. That may be optional for them, or it may be expected and required that they like invest the same amount, or they invest like a proportionally same amount into the business. in their Series B or their Series D round of financing. There's things like drag along rights, where if they want to sell, the business wants to sell, and they get a majority vote, they may be able to drag you along, and you may have to exit your position in the company if there's kind of an exit opportunity for the business. There's like right of first refusal, or yes, first refusal to people who they might get the right to buy a company outright if they're interested in selling. And all of these different rights for that you get as an investor will be negotiated on a term sheet. So term sheet could be 2 pages long or 50 pages long. It depends how like complex and you want to break down what your rights are as an investor. Maybe you want the same rights or different rights as another investor. And the term sheet is, there's other documents that need to be negotiated on in a deal, but the term sheet gets all of the key criteria primarily into that term sheet so that investors and founders can agree on those terms before they move forward with the deal.
All right. Jack, when startups raise funding from different investors, for example, angel investors or venture capitalists, etc. So, where is the difference between angel investors or the VCs?
Yeah. VCs will basically operate as a firm, and they'll be similar to private equity, where they'll try to raise other people's money, go to the similar investors, and they'll raise a fund. So they're putting in some of their own money probably, but majority is other people's money that they invest because they have better experience, better discretion or relationships in which startups they should put that money with. And they'll operate more as a business with those kind of incentive terms that we talked about. Angel investors generally are operating as individuals. You and I, if we have some savings put away, we might want to make investment in a company that we think is really promising, or we know the founder, and we don't do this full time necessarily as our job, but we are opportunistic and looking for deals in a particular industry or space that we want to invest in. So we become an angel investor in that sense. Angels tend to invest a little smaller than venture capital firms. They tend to invest a little earlier and take a little more risk, primarily because they haven't raised capital from other people. So they're not doing the scale of investment that a VC firm might.
All right. Uh, when startups has raised the funding, how
Mm-hmm.
many kind of or type of agreements are there, and which agreement is the most like startup friendly or startup founder friendly agreement?
Ooh, yeah. There are like a couple different structures, and I'm trying to think of all the like appropriate terms for them, but essentially startups will raise, you'll often hear about them raising equity, where they'll take in money from investors and sell an ownership piece of their business, but they may also raise debt potentially too, or a form of debt. And um, just loans outright, where a company might like take in $100,000 and pay it back later, sound great, but there are a lot of issues for a startup to be, taking on a lot of debt initially, primarily because the interest rate is another cost for them. If it's like a 5 or higher% interest rate, it's going to add a lot. They're trying to run really lean, and that's like going to be an added cost. Also, the investor debt investments, primarily the investor wants less risk than an equity investor might. So that's why they have a lot of agreements have come up that are types of convertible debt. So there's maybe a convertible note that a company might raise, where an investor is saying, here's an agreement where I'll give you this money up front. It functions as debt right now. Maybe you pay me an interest rate for a short period, maybe you don't, or that debt is paid late, or that interest is paid later. And when you have the next financing round or a significant event, that debt that I've loaned you will then convert into equity in the next round. And you may agree on a certain value that the company will be at. You'll say that the company will be at that round. Or you might just wait and see, what the value of the company is at the next raise. Generally, though, an investor will agree to a convertible note that's priced at a cheaper valuation of the company than what they think they're actually going to be valued at the next round. So they're kind of getting a little deal by giving the company the money earlier rather than waiting till the next finance round. And that's really nice, where a company who might need capital but they don't want to do a big round can do that as well. A simplified version of that is a safe note, which is simple agreement for future equity. And it will just be probably not be interest bearing. I'm not exactly sure what's the most common right now, but it'll be just a kind of legally binding, but a handshake agreement where they say, hey, we'll write a safe note, and then I will get equity in your business in the next financing round.
All right. So, Jack, how much time it takes in the whole process of raising the funding for a startup? For example, once the things are started, how much time could it take to finally raise the round?
It could be, that's a good question, because it depends a lot on your business, and companies could be raising many, many rounds. It's possible. I haven't heard of like 10 or 15 rounds, but it's definitely not out of the question. Usually companies will do 5, 6, 7 rounds before they like get private equity funding, or do another type of exit in the business. And some founders will tell you they're always raising, and even after they close their Series A or Series B, they're networking, building relationships, and thinking about how they're going to get to their next valuation at the next financing round. So it never really stops. The formal process where a company will reach out, they'll be writing term sheets, or the investor will be writing term sheets, and they're actively negotiating, will probably last anywhere from like 2 months to 6 months generally before a round. And they'll probably raise rounds every 1 to 3 or 4 years. That's just like a rough estimate I've seen. That could be getting shorter or longer. I'm not really sure.
All right. When we talk on the return on investment, uh, with reference to the different investors, for example,
Mm-hmm.
angel investors or VCs, and with reference to the capital amount which is being raised, how much equity usually investors expect, and what is the standard and criteria how the equity is actually decided that okay, the investors will take this much equity from that startup?
Yeah. So kind of how much like founders are hoping to give away in
That's
their,
right.
and kind of are you saying what do investors expect to earn on that equity?
Yeah, actually how much startup founders are going to give away.
Yeah. Um, that depends a lot on how much you want to grow as a business, how much you want to leverage your business operations with other people's money and how many years you want to grow, because you could raise a good amount of money up front, but you might need, like, for 5 more years, you might need more and more capital infusions where you have to give away higher and higher amounts of equity. So in general, especially when a business is early, it doesn't have a high valuation, at a bare minimum, the founders want to keep at least 60% of the business, at least a like solid majority, where they're not in a position or have a risk of being overruled. Some investors, some founders, there might be a majority founder that wants to keep 55 or 60, and then they'll have another one or two founders, and they want to give them 10 or 20% of the business, so that they, even though there's a group of founders, they still have control over the group. Or maybe between the two of them, two founders, they don't both have control individually, but together they have 60 or 75% of the business. As you get bigger and you're more comfortable, the business is stable, and you've built a good team around you, and maybe on your term sheets you have specific protections in place for yourself, you may be comfortable giving up your majority ownership stake. And publicly traded companies, Mark Zuckerberg for Facebook and Jeff Bezos for Amazon, I believe eventually over time they might have 10, 20, maybe even closer to 5% of their business that they still own. That's something I should look up, because that would be, like, I know it impacts their net wealth a lot, but that's something I think, as you get to be more of a public company and you have exits, you're willing to give up more and more of your ownership percentage. And generally in a round, you'll give away 10 or 20% of the business in any round, but there'll be some dilution impacts where on the cap table you're creating new shares. So you're not giving away it's not a zero-sum game where if you're offering 10% equity, you're losing 10% equity from your 100% stake. There might be some dilution where you're creating new shares that go into the table on the cap table, and there might be some math that you have to do for that. I hope that made sense.
All right. And when we talk on the ROI, return on investment, how investors decide that, I mean, how much ROI they should expect from the startup? For example, 2x, 3x, 10x, or what?
Yeah, it varies depending on they say East Coast startups, or sorry, East Coast VCs and West Coast VCs. But across all of them, your winners, your really successful startups in your portfolio, will pay for the majority of losers in your portfolio. So you'll have a lot more losers, to put it in a blunt term, than winners. And your winners will be 2, 3x, 10x, as high as maybe 100x if they become a unicorn and a decade unicorn and you got in really early in that space. That's definitely possible, and that could pay off your returns on that when the company exits, could pay for your whole fund. It could drive a lot of returns from the fund, so that you're not as worried about those companies where you exited at a 50% loss, or you exited at a total loss of the company. West Coast VCs will tend to more focus on the 10, 20, 30x returns when they're investing in a business. And then East Coast will be more conservative, and they'll try to get 4 or 5x, maybe 10x returns on their companies that they invest in. So it's really just your style and philosophy as a VC investor. And private equity tends to be more maybe more conservative and less optimistic about those 10 or 20x returns, just because the business, if they're buying a $2 or $3 billion business anyway, there's only so much runway that it can grow as a company. So it's probably not going to 10x as an investment. You'd just be happy to 2x the investment, but at the same time, you're less likely to lose all of your money that you put in.
There is another term we listen, valuation. What is valuation? How it is calculated, and when it is actually calculated?
Yeah,
To what
value.
stage?
What yeah, kind of what the model process is of it. It is model based. I've given that away already, but basically it'll just be pretty simply, it's a formula of how much the company's worth, and you could be on either side of the transaction. You could be wanting to sell the company, you could be wanting to buy a new company. You just be holding it and wondering kind of where it's at right now with how much it might sell for if you had to sell for tomorrow. But it looks at the entire enterprise value of the business as a whole. So you'll have the ones that I've worked on are in Excel, and they have a lot of tabs that communicate with each other and feed into a summary page, and then ultimately the ending number of the company's valuation at the end. But you're taking the financial statements of the company, and it's you're looking at the balance sheet to look at its capital structure, and then you're looking at the cash flow statement and income statement to see what are its earnings, what is its free cash flow coming out of that. And that needs to be second nature as you're thinking through these valuations and tweaking things, which is why the accounting fundamentals and like investing experience comes in really handy in building these and working on these, because there's a lot of uh, formulas and accounting equations within these valuation models that you need to have an understanding of to get back to the total number. So common valuation formulas and approaches you'll see are market driven or intrinsically driven. And intrinsically driven is, it has to do with, like I said, kind of those earnings of the company and how it's performing itself. You do a discounted cash flow valuation of the company, and you project out over the next 10 years how much cash flow is there going to be, and how much would this earn kind of the holder of the business. And therefore, if I discount those future cash flows to the present day, how much would it sell for? Because an investor that buys it is very much future focused, and they want to know in the future, what kind of cash flows can I expect to get from the business. Then the other approach is market-based approach, where you look at what are publicly traded companies, which I have a lot of data about. What are public companies valued in this space that might be similar to my company? And I'll make the adjustments as I need to. But from public market information, I can understand how much my company's worth, or other private equity transactions that have happened. Whatever data I have about those transactions in the past, or transactions even that I've made as an investor, I can begin to get a sense and compare it to the company I own now of how much it might be worth. Oftentimes, PE firms will use a mixed approach where they'll look at intrinsic and extrinsic formulas in their valuations.
All right. So, what is an ideal pitch deck? What are the most important things and numbers that startup founders must cover while they are briefing to the investors?
I think what um, is most valuable. You're talking more when you're looking at pitch decks, numbers I would keep the performance numbers and the targets at the back, and at the front of the pitch deck, I would drill as soon as I can in the presentation exactly what the value proposition is, and then how the company can deliver that and why they're in a better position than maybe other competitors to deliver that. So immediately when you're in front of an investor and you're the founder presenting, you want your value proposition to be crystal clear. You want to have be decisive and have a very good understanding of your customer and why you can give them exactly what they want. And then you might break out kind of the steps of how exactly you plan to do that or how you have done that and what resources you want to add on to your business so that you can do that even better. Once the investor has the value proposition drilled into their brain of exactly how this company works and they have confidence in you as a founder, then you want to show how you've done so far. If you've gotten some traction with customers, maybe you have some revenue already coming into the business, that's a great sign that your value proposition is already working in the market and there's potential for it to work at a bigger scale. And what your targets are for the next several years. I wouldn't do 5 or more years for those projections, but 2 or 3 year targets for revenue and maybe a path to profitability can be very helpful for the investor because they're looking at those future returns and it will be indicative of how much the company can sell for in the future.
All right. So, after the pitch deck and after the brief of the startup founder, if investors thinks, okay, we should consider this and startup to invest in, before they decide to invest, what kind of documents, reports, and records investors can ask to startup founders to share with them before they decide to invest?
Yeah, good question. So they'll get a copy of the pitch deck. They'll often a founder will lead kind of the process with a proposed term sheet. If they have other investors buying into that financing round that have already agreed to that term sheet, even better. That will pressure the investor to kind of sign and buy into that those terms and rates. They look at a more detailed financials. You'll often have to share um, breakdowns of your expenses and your prospect funnel or your sales funnel, exactly who you've talked to that's a potential customer, who's doing you know trials where they're thinking about buying or they're currently buying at maybe an introductory rate, and then who are your core customers that are bringing you revenue. Um, then you might want referrals from those customers, and it'll either be a testimonial that's written or just the contact information so that the VC can talk to those uh, those customers and understand what kind of value they're getting from the product and if they intend to keep buying in the future. And then, yeah, on top of that, you might have different IP that's either been patented already and you have the legal patent on the business, or it's kind of um, a trade secret and you're keeping it close to the chest and maybe you're trying to get a patent. You often share that intellectual property with the founder, and then there'll be a series of a few weeks or a few months where you'll be answering their questions on those materials as they dig deeper and build more confidence in you as a founder.
All right. So, Jack, once all the records and reports are submitted to the investors, before the investors write a check, how they ensure that startup founders or the startup team is not manipulating or lying, how they verify all the traction and all the projections.
Yeah, that can be a real issue. Like we have all seen the Theranos founder, Elizabeth Ohms, inflate numbers and not have any kind of real sales or traction, which is something you don't want to be in a situation where it's a very serious thing. You'll cross verify where I talked about you'll talk to customers, you might talk to other investors who have worked with this company and these founders in the past. Um, you'll have the founders sign in the contracts and transaction agreements statements that they're verifying the accuracy of these projections against the penalty of law. There's subjective things where you want to find out. We talk about those sales prospects, how optimistic is the founder, if they're giving you a realistic picture or this is really the pipe dream of the kind of revenue they're going to get in place. It's a red flag if the founders immensely confident, doesn't anticipate any risks or pitfalls stopping them. If you have a good founder, they'll be very candid about what could slow up their progress, what they're solving or protecting against, and will have a very open and transparent relationship with you about what their projections are and how they've arrived to those.
All right. So, uh, Jack, suppose the startup is failed or collapsed, then what happens? What about the investment of the investors? Will they get that back, or what happens to that?
Yeah, there's man, you're bringing me back to uh some of my early days interning in VC. I'm going to try to conjure up uh the terms that they use, but I'll just talk like in general what happens. What the general process is a liquidation of the business generally, unless they'll look for when the business is failing, they'll first look for a bigger business generally that can might be interested in buying the company below cost, that could run it more effectively. So they'll try to do what's called a fire sale, sell the company at a discount. There are a lot of companies and even like private equity firms interested in that and are open to that kind of transaction. So a lot of times that will happen, but there's also a very likely chance that you'll have a standard bankruptcy of the business, where just like any business, it will file for bankruptcy and there'll be a liquidation process where if you kind of understand the capital stack for a company, debt founders or sorry, debt investors always get paid first before well, there'll be kind of like maybe vendors that have accounts receivable with the business and they've shipped computers or supplies to the business and they have actual bills that they've invoiced to the company. They'll generally get paid first so the business can cover like its day-to-day, catch up on its like day-to-day bills that it's incurred. Then after that, the debt investors, which there won't be a lot because I mentioned it's a startup and it's not always practical to loan a company money. But if they have sort of a line of credit open with the bank, that's not a huge amount, but it's kind of a revolving credit line to run be working capital for their day-to-day operations. Bank will get paid back first. Then if there's any, that will be kind of the senior debt that is like the most high secured debt and might be at a lower interest rate. And then there might be like less less secured debt that might not be from a bank, but might be somebody else that they'll get paid back after. And then there'll be a liquidation preference, which is in the term sheet. And basically, equity investors will figure out, kind of based on the round that they got in with the financing rounds, when they'll get paid back over other equity investors. And then once the equity investors have been paid back, maybe there'll be some money for the founders, but often there's not a lot of assets at these startups, and they've invested in a lot of the marketing and intangibles. They won't recover enough money to pay back all those equity investors. So most of them are taking at least a partial loss, sometimes 100% loss, if all the money has gone to debt.
Suppose the losses are so bad that startup is unable to pay every vendor and all, the investors or any kind of other liabilities. So
Yeah.
at the end of the day, they don't have assets or money to pay back. So, and they are bankrupt. They have announced it. So,
Yeah.
is there any liability on the founders yet, or what?
Um, this is a good legal question. If you have lawyers on your podcast, which I'm sure there are many that would be interested in coming on. I know by definition, limited liability company, it is, um, the when people kind of sue the company over civil issues, or they're not paid back or damage has been incurred, they will sue the company in a business. They can't sue the founder themselves. And I think that transfers to a C corp as well, which is what you'd be structured as when you're raising venture capital money. So, generally with bankruptcy, I think you're absolved of your debts and obligations, although there may be some recourse that those uh, people have as well. But I think basically with the standard bankruptcy filing, you're off the hook there. And there are a lot of people who take what we call haircuts, where they're losing 50% or all of their money.
All right. Uh, we are almost done, Jack. We have just a couple of more questions, but very short and quick answers. It is usually said that investors want to kill the startup founders. For example, Uber founder said this, that startup founder, the investors want to kill the startup founders. Is that right?
Hmm. Investors want to kill the startup founders.
Yeah.
That can be true. Unfortunately, all is fair in love and war, and investing can be a brutal place. I would encourage, like I would say, as an investment professional, that the um, in, incentives are aligned 99% of the time when you're writing a investment agreement and these term sheets. A good investor that thinks long term and wants to create value, they'll align with their invest incentives with the founder in every possible way that they can. And that's usually what creates the long-term value. However, you have to be very cautious and wary as a founder of the kind of agreements that you're getting into with investors. Even if you have a majority stake, there may be ways to undermine your decision-making power, even remove you from your position as chief executive officer or whatever it might be. Um, be upfront with the investors about kind of what their expectations are and how they see the business growing and what needs to happen. A lot of times a founder will grow the company to a certain point and say, I understand that it's industry practice that they'll bring on a new CEO at some point. And when the company gets big enough, I don't have experience running 100-person or a 500-person company, and we need a tenured CEO for the best interest of the business. So there can be fights between the investors and the founders when something that might be best for the company's interest is not 100% best for the founder's interest. And there are misleading things and kind of disagreements and spats that happen, and there could be hostile kind of removal of the CEO, doing things to increase the value of the company overall, but in the short term makes things harder for the employees, which can certainly happen when we prioritize, growth above all else. But that is the, cautionary tale of the founder. Try to maintain more control when you can, and be thinking of protections for yourself in place, and what you can do as a founder to make yourself happy, the business and your customers happy, and your investors happy as well.
All right. Jack, do investors always ask for the management control, or sometime equity share is enough? I mean, is it standard or a fixed rule that investors must have the management control? I mean, because this is the point where startup founders lose management control.
Yeah. And it's their baby, right? They may have spent 5 years, 10 years growing this company, made a lot of sacrifices,
Yeah.
and taken more risk than just somebody else working in another job. And they really have had the sole person or people that have this vision to see it through. So there might be programmers and people that are very technical that have built apps that aren't as interested in running the operations and have partnered with a good business operator that they feel okay running it. And then there may be people that are trying to hold on to their business as long as they can, that really feel like they need to be running the day-to-day of the business. Even if, even depending on the founder's preferences, it is very nerve-wracking for the founder who has so many of their eggs in one basket, and this equity that they own in their own business is kind of their path to um, being wealthy, and maybe selling at a high exit to bring somebody else in and not be involved in running the company as much. Maybe you have that 50% equity stake in your business, but you suddenly lose control of whether the business does well or it does poorly, and you sell the company for a lot of money, or you have that fire sale that happens. So that's just another risk that founders take on in their entrepreneurial journey. Not something I've experienced personally, but I know that it can be very nerve-wracking. You don't exactly know kind of what's going to happen sometimes as you're a founder.
All right. So once the decision is made and investors decide to invest in, how the funds are issued? I mean, they write a check and that directly goes to the company account, or what? What is the process?
Yeah, sometimes there's payouts of the money, like conditional. If they meet certain revenue goals, they'll get the money at that point. Generally, and what investors and founders think is best is like they get all the money up front, it goes into their account, and then they can like begin to front load on their marketing and hiring developers, and they make all these expenses up front to hopefully lead to that higher growth of the business as it happens. So yeah, generally it'll go out of their account. There might be a couple weeks delay, where, as I mentioned, the VC or the private equity person running the business will then have to go to their investors and say, you committed this money to our fund a year, however many years ago. We need X amount of it to now make this investment in the company. And then that will go from the company, or go from the investor to the VC firm and then into the company account. So it'll generally, yeah, happen once the deal or financing round has been closed. It'll generally happen pretty quickly.
All right. So, Jack, keeping in view the emerging technologies and speed of change, what do you think? Which sectors investors will prefer to invest in the future?
Mm.
Which
I
startups? Which space? Which sectors?
Yeah. I think climate tech is going to be really big. It's been honestly challenging to monetize. It's been takes a lot of investment up front. It's like a lot of R&D, but I think we need these big changes as a society. We need better batteries. We need better and smarter grid systems, um, more efficient, like kind of power generation systems to flip that proposal to make it cheaper than using fossil fuels. I think once we solve that equation and make it easy to do, there's going to be a lot of money coming in. Personally, really optimistic about education technology. Coming from an education background, there's a lot of things we can do to bring down the expensive costs of higher education, make teachers able to teach more students and learn more quickly. And then um, supercomputers and AI, that's kind of on the bandwagon of what you may hear a lot of investors talk about, but I think that is the future. It's going to touch all of our all the sectors that we invest in, and there'll be some degree of uh, enablement where we have better sensors, better like technology being used by every employee, and that will increase productivity uh, across the board. And I think we'll see industries in different ways looking to this AI and this new technology to increase their productivity and make their businesses more efficient. So I think that will touch everything. And if you want something that is going to be pervasive, that is the a good bet. I know there's a lot of hype around it, but I think you should look at specifically how the transportation sector or the real estate sector is going to use AI in these tools, and then make smart investments uh, with companies that are applying this new kind of AI superpower we have to that space.
All right. Jack, what would you recommend for professionals hoping to break into private equity?
I would say, don't be discouraged by, I work with really incredibly smart people that have done everything right since like birth, it seems, and they're very qualified and have a lot of degrees. But I didn't get into private equity the traditional way, and there's a lot of opportunities now that have been broken out within the private equity industry for people to add value and use their skill sets. Those tend to be numbers driven. Be really sharp with your technical skills and look for opportunities in the organization that you work now to manage very complex processes and work with numbers. Don't have to have an MBA like I do, but I think that trained me to network really well. And you're going to have to be very savvy um, making connections with uh, people in that field and figure out how to add value in those relationships early on to find a way to get your foot in the door.
All right. Jack, what are current books you are reading right now that you would recommend others to read?
Yeah, I'll give you a couple books and then some podcasts as well. 'Cause I know people are on the go all the time. They're not always have time to sit down and read for a few hours. But Atomic Habits by James Clear is something I have read early this year, and it's really helped the way I think about like systems and setting up my day. I wasn't always into self-help books. I don't know if I'd call this a self-help book, but it's changed the way I think about how I approach problems and break complicated things down into simpler components. I'm also reading the 80-20 principle, which is, the Pareto principle kind of broken out into modern day problems and applied that way, which I really like. The private equity playbook was really helpful to me as I was breaking into the industry, taught me all of this jargon that I've broken down now, but it's in like a more simple format than I probably explained it, that you can go back to and look there. So check out Private Equity Playbook. For podcasts, I'm listening to How I Built This, which is just an all around great and really easy to listen to interview segment with founders with a lot of cool companies like Patagonia, Cotopaxi, Dave's Killer Bread, like a lot of ones that you wouldn't think about. For getting up on the industry, I listen to Deal of the Week by Bloomberg. It's normally like some of the biggest deals that are happening right now. And then The Full Ratchet, which breaks down the mechanics of what it's like to be an investor and how you're like kind of how you do negotiations and work and figure out all that stuff. So check those out definitely, and I hope I can be helpful to anybody who is interested in the private equity space or just the business and entrepreneurship economy in general. I'd love to meet more people and get connected with them.
Jack, thank you so much for joining, and trust me, it was really insightful. You have such a great grip on this topic, and really thank you for joining. In the last, would you like, other than the topic, would you like to give any inspiring message to the potential entrepreneurs, startup founders, or university students? Any inspiring message that could change their life?
Yeah, something everybody's heard before, but it's helped me a lot. But the biggest thing is getting started, and um, I've had a lot of things where I would end up doing the second or third or trying different things to get where I wanted to go, and didn't always end up kind of at the opportunities I expected. But it's all about seeing things in a new light, looking for the opportunities of where you can get to what you want to, identify the gaps of the skills that you currently have and what you need for your next opportunity, and just take small baby steps to build those skills, build the connections you want, and you'll get there. It's just a matter of time.